Hello, my name is Fabian Degen. I am the owner of FMD Wealth Advisors. This is my podcast, Don't Screw Up Divorce. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after the divorce, and I work with clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a call with me. We are open for business. So, this week's podcast has the following title and the following focus: The Divorce Tax Trap. Why two equal settlements are almost never equal. Tax is the dimension of divorce that hides in plain sight. It does not appear in the headlines of the settlement agreement. It does not get argued about in court, and yet it can quietly reshape the value of every line item on the page. Two divorce settlements with identical headline figures can leave the two spouses in dramatically different financial positions once the tax layer is accounted for. The settlement that splits the marital assets cleanly down the middle on paper can be the settlement that hands one spouse a substantially better deal in practice. Most tax attorneys are aware of tax issues, but are not tax specialists. And most tax professionals are not specialists when it comes to divorce law. The space between the two professions is exactly where the most expensive mistakes happen. This podcast focuses on what those tax issues are, what the risk is, and how to structure a settlement that does not give away value by accident. Tax planning in divorce is not about being clever. It is about being aware. The rules are well established. The question is whether your settlement reflects it. So let's go back in history and let's look at the post-2018 maintenance rules. So for decades, spousal maintenance was deductible to the payer and taxable to the recipient. That structure made high maintenance figures more tolerable because the payer was effectively sharing the tax burden with the recipient in a lower bracket. Since the Tax Cuts and Jobs Act took effect for divorces finalized after the end of 2018, that structure is gone. Maintenance is no longer deductible to the payer and no longer taxable to the recipient. The practical implication is that paying $1 in maintenance now costs the payer a full after-tax dollar, and the recipient keeps every dollar they receive. The pre-2018 math no longer applies. So for high-income payers in particular, this often makes a structured asset transfer, for example, a larger upfront share of liquid assets, for example, more efficient than a long stream of maintenance payments. The same value can sometimes be delivered to the recipient at a meaningful lower after-tax cost to the payer. So let's talk about the asset cost basis trap. So when marital assets are divided, the transfer itself is generally tax-free under Internal Revenue Code 1041, which treats transfers between spouses incident to divorce as non-taxable events. That sounds like good news, and as far as the transfer is concerned, it is. But the receiving spouse takes the same cost basis the transferring spouse had. So embedded gain rides along with the asset. So for example, two stocks worth $500,000 each can carry very different tax bills. One might have a cost basis of $450,000 with $50,000 of embedded gains. The other might have a cost basis of just $100,000 with $400,000 of embedded gains. So the first stock can be sold with very little taxes. The second cannot. So a settlement that divides investment assets purely by current market value without looking at cost basis can quietly hand one spouse a portfolio with much larger tax liabilities. Equal market value in this case is not equal after-tax value. Let's focus on another area, and that's the marital home and the associated capital gain treatments. So the marital home is often emotionally and financially central to a settlement, and it carries its own tax considerations. Under current rules, a single filer can exclude up to $250,000 of gain on the sale of a primary residence, and a married couple filing jointly can exclude up to $500,000. The exclusion applies if the home was the seller's primary residence for at least 2 of the 5 years before the sale. The timing of the sale obviously matters. If both spouses sell the home together before finalizing the divorce, they may be able to claim the full $500,000 exclusion. If one spouse keeps the home in the divorce and later sells, only the $250,000 single filer exclusion applies, unless certain ownership and use rules are met. So for homes with substantial embedded appreciation, which is especially common in high-income areas like New York, the difference between $250,000 and $500,000 of excluded gain is significant. The decision about whether to sell jointly, transfer the home in the divorce, or keep it for a later sale should be made with full visibility into the tax map. Let's talk about retirement account taxation. As covered in one of my earlier podcasts on retirement accounts, traditional 401ks and IRA dollars are pre-tax. Roth dollars are after-tax. And the difference is enormous over a multi-decade horizon. From a tax structure standpoint, the simplest rule is this: do not treat retirement dollars and after-tax dollars as interchangeable in a settlement. Adjust for the embedded tax in pre-tax accounts. Recognize the structural advantage of Roth assets. There's also a tactical consideration here. For couples where both spouses will eventually be in the lower bracket in retirement, traditional accounts have a relative advantage. For couples where one spouse is expected to be in a much higher bracket later, Roth accounts have a relative advantage. The right split is not always equal. It is the split that minimizes the combined tax burden over the rest of both lives. Let's talk about another topic, and that is stock options, restricted stock units, and deferred compensation. So stock options and restricted stock units are common in high-income households, particularly in finance, technology, and professional services. They are also among the most poorly handled assets in divorce settlements. Vested options and RSUs, restricted stock units, are usually marital to the extent they were earned during the marriage. Unvested options and RSUs sit in a more complex zone because their value depends on future services. New York courts have applied various formulas to determine what portion of the unvested award is marital and what portion is separate. Tax treatment varies as well. Non-qualified stock options trigger ordinary income at exercise. Incentive stock options have alternative minimum tax implications. RSUs are taxed as ordinary income at vesting. Deferred compensation may be taxed at distribution. Settlement agreements that handle these instruments well typically specify not just who gets what share, but how the underlying tax burden is allocated and how the timing of exercising or distributions will be coordinated. Let's talk about another topic: your filing status. Your filing status for the year of the divorce can affect your tax bill more than you might expect. If you are still married on December 31st, you can file jointly. If you are divorced by that date, you cannot. Joint filing usually produces lower combined taxes than separate filing, particularly for households with significant income differences between the spouses. The timing when a divorce is finalized can therefore have a real dollar tax impact on the final year. If you are negotiating in the later half of the year, it is worth modeling the tax effects of finalizing in December versus January. The right answer depends on the income mix, the size of the expected refunds or balance due, and the relationship between the spouses. Similar care should go into who claims the children as dependent, who claims the head of household status if applicable, and how any net operating losses, capital loss carry-forwards, or shareable contribution carryovers are allocated. These are small line items individually, but can add up significantly. So in conclusion, make sure that you build your settlement with taxes in the picture. Tax is the layer that determines whether the headline settlement and the real settlement are the same number. The fix is straightforward in principle and demanding in practice. Bring a tax professional into the planning of the settlement, not just into the filing of return after it is done. Model the tax impact of each significant decision. Look at after-tax values rather than nominal ones. A settlement built with taxes in mind from the beginning is rarely much more complicated to negotiate than one that ignores tax. It just looks different, and it tends to look different in ways that protect more of the wealth that both spouses have spent decades building. So now, let's get through some questions that I received. Do I owe taxes when assets are transferred in the divorce itself? Generally, no. Transfers of property between spouses incident to divorce are tax-free events under federal law. The receiving spouse takes the same cost basis the transferring spouse had, which means embedded gain transfers along with the assets. Taxes are owed when the receiving spouse later sells, withdraws, or otherwise triggers a taxable event with the asset. Next question. Is child support tax deductible? No, child support is not deductible to the payer and not taxable to the recipient. It is treated, in effect, as the payer's after-tax obligation to the children. This is one of the reasons the structure of total support, so the split between child support and maintenance, matters. Both are now non-deductible, but they have different durations, modification rules, and ending events. Next question. Can we file jointly in the year of divorce? Only if you're still legally married on December 31st of that year. If your divorce is finalized between then, you must file as single or, if eligible, head of household. The timing of the divorce can therefore have a direct tax cost, particularly when one spouse earns substantially more than the other. Discussing the year-end filing implication with a tax professional before finalizing the timing is really important. How do I make sure my settlement reflects the tax map? Well, bring a tax professional, like an enrolled agent, into the conversation early and ask your certified divorce financial analyst to model the settlement on an after-tax basis. The most useful exercise is to compare the after-tax present value of 2 or 3 alternative settlement structures rather than argue line item by line item. Once you can see the after-tax shape of each option, the right structure usually becomes clear. This was this week's podcast, Don't Screw Up Divorce. My name is Fabian Degen. I'm the owner of FMD Wealth Advisors. I'm a certified financial planner, chartered financial analyst, enrolled agent with the IRS, certified divorce financial analyst, and certified Quattro specialist. I help people that are going through major life transitions like divorce. I'm supporting my clients before, during, and after divorce, and I work with clients nationwide. If you would like my help, click the link in the show notes or visit fmdwealth.com to schedule a call with me. We are open for business.